So here we go on the second episode of A to Z on financial market. We're going to discover quite a lot in this episode. We're going to discuss what's trading, why to trade, what's investing and investing with trading. Next, we go to talk about what's shares and why companies offer them. And then we're going to look at what's the key components of share price movement. Let's go. Hey guys, welcome. This is Aryan. Just imagine you put all your monies in a safe somewhere, no matter how much it is, and then leave it for a year and then come back to it. What do you think will happen to that money? Well, the good news is you haven't lost it, right? But the bad news is it hasn't grown at all, and it's the same amount as you've put it last year. But in fact, we can argue that we have less money today than last year with the same amount of money because the money we have lost its buying power, meaning the cost of living since last year is likely to be higher. Now imagine putting your money instead of safe in financial assets, which can be shares, commodities, cryptocurrencies, properties, or any other financial asset. So your money, instead of lying down in a safe, had a greater potential of growing itself in an investment, which those investment could go up in the price. Also, as you probably guessed it, there's a downside after every uphill and there is a bad news after every good news, right? So in the financial market and in investing, you can gain money and you lose money. So those investments could go up in the price, therefore your profit, or they could go down in the price and you lose money. And believe me, you will lose money if you start investing. That's the part of the game. In the financial market, the rule of the game is to balance those risks with the gain or rewards you're potentially looking forward to, and picking assets that likely to move in your favor, which in that case your reward would be much higher than what you get from putting your money in a safe or a bank account. Okay, that was simple enough, right? Now, investing with trading. As I mentioned in one of my previous videos, which I link down below or here, what we just talked about is called investment. So essentially a long-term form of financial trading which is involved buying and holding those financial assets for a long time, such as months or years, or if you're Warren Buffett, for decades, or you just don't sell it, you hold forever. And that is called investment. The fun fact is you may be already an investor in a company or a bank. If you have any kind of pension plan that is investing in a companies, then you have indirect investment in those companies. Or if you have ever bought any shares of any companies, then you became an investor of that company, which in this case you're called a passive investor that is not involving in any kind of trading over the time. You just buy and hold and keep it. But really, long-term investing is not the only way you can participate in the financial market. There are many people who trade more frequently and in a weekly or daily basis. They are sometimes known as speculation. So invest long-term and you're investor, or trade more frequently or short-term and you're a trader. So basically, investors are looking for long-term investments, which they're looking to buy and hold investments in a long term and build a portfolio which is going to be profitable in a future time. But active traders are looking at the short-term market movement, with some people doing hundreds of trades per day. Now I know I'm focusing too much on investors and traders and the meaning of them. But believe me, many people are starting in the financial market and they don't know the difference between two. You should know what you're going to do and therefore plan for the future. If you're going to be an investor, you're going to take another road from a trader. But whether you choose to trade just a few times a year and become an investor, or you believe that there is an opportunity in every movement of the market and you want to be a trader, it's entirely down to you. It depends on your personality, your budget, and how much time you can devote to it. I'm going to make a video in the future on how to do your planning or even risk management on your trades or investments. Which, if you're looking at this video right now, I probably haven't made it yet. But if it's in the future, then it should be down in the description or up there. But it's just important that you know that there are many ways of trading and also many kind of traders out there in the world who are having their own approaches to the financial market. Therefore, you can have your own ways of trading. One of the differences between traders are the different kind of assets they choose to trade, which that is a talk for the next lesson. But mostly when you hear about investing or trading, it's mainly on share market and trading shares. Shares are the most popular assets and the most traditional one in the financial market, which is really popular among individual investors because it's cheaper and easier to trade. But remember, share market is just the most common traded financial asset in the financial markets, not the only one. Now, what is a share? As I briefly explained in the last video, share is a unit of ownership in a company. So if a company worth $10,000 and they issued 2,000 shares for the company, then each share would worth, yes, $5 a share. 10,000 divided by 2,000, $5. So as a share price fluctuates in the market and goes up or down, so does the value of the company. And investors naturally buy shares in a company that they are hoping it goes up in the value. Therefore, they can sell it in a higher price and then make some profit out of it. So let's put it in a scenario. Company X is a well-known private company who, let's say, sells digital products. And the value of the company is currently $10 million. Owners of the company want to raise money and expand in new territories and countries. So logically, if you want the company to be successful, then you should very gently push that like button. I'm serious. Push that like button. Thanks. Thanks. Okay, back to be serious and talk about Company X. We're deciding on the future of it, right? So now, as the company want to raise money, they have to sell a portion of business by issuing stocks or shares, which, let's say the price of the shares are $2 per share. Now, you, an investor, want to start investing in the Company X PLC, which you believe it has a good future, great business strategy, and even a better products. So naturally, you decide to invest $10,000 of your hard-earned money in the Company X PLC, which is enough to buy 5,000 shares in the company. Now you own 0.1% of the company. So after a few months, your investment start to working for you and Company X start to sell more and more digital products. Then the news gets to other investors or traders, and therefore everyone heard about the company, everyone want to jump on the train, and everyone want to have a piece of this action. Consequently, you can see the price of Company X is up from $2 to $3 per share. Now you have $15,000 worth in the Company X, meaning you have $5,000 in profit if you choose to sell, which you freely can. Or you can hold on to those shares in the hope of the future growth and having even more profit in the future, which, as we mentioned before, there is always a chance of share price to go down as well. But logically, if you can see Company X as the next Apple or Tesla, then you would hold on to the company's share or even buy more, regardless if in the short term the price is going down or up, because you know you're going to hold on to it for a long time to get the most possible profit out of it. So it's essential that you have done your research on both the company itself and its industry, which many people say it's very beneficial for you if you're investing in a company that you are expert in or you know it very well Therefore, the research is a lot easier and you know all the concepts and specialties of those industry or those companies. Another benefit on having shares, which we see rarely in other financial assets, are dividends. Dividends basically represent your shares of company's profit, and they are usually paid twice a year. The amount of the dividends paid by the companies are very different depending on the size of the company and how growing or established the company is, or even if the management want to distribute the profits to the shareholders or keep on them for the future investment or growth of the company. So you should research the dividend before investing in the stock market if the dividend is important to you. Now, if you find this information useful and you have some benefit out of it, please like and subscribe, so it helps YouTube algorithm to show this content to more people who needs this. And even if you don't care about the algorithm, do it for the sake of company X. As always, if you have any comments or questions, comment them down below and I will make sure to respond to all of them. Thank you so much for watching this, and I will see you in the next video. Catch you later.